Did you know that an average US family is paying roughly $350 more per month for the same goods and services as they did a year ago? That means roughly $42,000 per year. Are you aware that the S&P 500 index has plummeted roughly 21% from its peak in January 2022, NASDAQ 30% from its peak in November 2021, and Dow Jones is down 17%. The markets have now officially entered a bear phase. Will the markets nosedive any further? Can we expect an asset crash as well? Are the recession bells ringing already? Can you still benefit from this fall? Yes, you heard it right. I'm talking about benefit. Want to know how? Watch this video to the end to find out. First of all, let's understand why the markets are looking like a slaughterhouse. The first reason is record high inflation at 8.6%. The highest in the last 40 years. Inflation is an economic state where more money is in circulation, chasing the same quantity of goods or services, which gives an impression of rise in demand, and the result, prices skyrocket. But how can inflation make markets fall? If prices are rising, companies are earning more profits, right? No. When inflation increases, the cost of raw materials, labor, input services, etc. also increase, leading to a rise in overall cost of capital for the companies. Further, the prices of goods for services sold cannot be increased anymore because obviously, Fed and the government are trying to bring it down. This simply means lower profits, leading to lower valuations and hence a fall in stock prices. This fall creates a negative sentiment and a state of panic in the market, and as a result, a selling pressure arises, leading to a further downside. Plus, inflation creates a pressure on individuals as well, because their purchasing power is the same, but stuff is now expensive. Bottom line, more money is needed to fulfill the essential requirements, and from where will this more money come? Diluting the investments and withdrawing from the stock market seems to be an easy choice. However, US is not the only country going through this low. The global markets are facing a bloodbath, including India, China, Japan, Korea, UK, Australia, and more. The central banks all around the world are trying to control inflation. Recently, Fed further hiked the interest rate by 75 basis points, the highest since 1994. Fed is trying to control inflation by implementing two major strategies. 1. Increase interest rates. Higher rates make it more expensive to finance spending and investment, which should help reduce demand and contribute to lower inflation. 2. Shrinking its own balance sheet. That is, selling off its assets partially in order to reduce money supply in the economy. So this is how inflation is a major cause of falling markets. Moving on to understand why markets are falling. Reason number 2. Russia-Ukraine war. In 2021, USA imported 245,194,000 barrels of oil from Russia as per a report of U.S. Energy Information Administration. And now, Russian oil imports are banned. I think you're smart enough to do the math yourself. Immense oil shortages leading to gas prices to go beyond $5 a gallon. Gas prices rising implies transportation getting costlier, making everything else costlier, and here, life makes a full circle and we are back to inflation. Reason number 3. Rising concerns over China's economy. China is once again into lockdowns to control the fresh spike in cases of COVID-19 virus. Now, after understanding the reasons for the fall, let us move on to find answers to some questions. Will the markets nosedive any further? Short answer, yes, there are high chances. The American stock market currently appears to be overvalued by 51%. In other words, it would take a 34% drop to bring the market back to the long-run equilibrium level. Please note, these figures are after adjusting for future incomes and inflation. The blue line shows the present level of markets. The red line shows the optimum level of markets. This is plenty of scope for this gap to be covered. Hence, it would be rational to say that markets can further dip. Next question. Will there be an asset crash as well? Short answer, yes. Again, there are high chances. Why so? Let me explain. Look, major assets include stocks, real estate, residential housing, and the latest entry, cryptocurrencies. We have already discussed about stocks. Now, about housing. Interest rates are being increased constantly, which means that borrowing and mortgage rates are also going to increase. It will be difficult to borrow money to buy houses. This will further lead to a fall in demand of housing prices, resulting in fall of its value. As per the Case-Shiller Home Price Index, housing sector is overvalued by 50%, which simply means prices may fall to 50% of current valuation. The recent interest rate hike by the Fed will result in high mortgage rates, and housing now seems to be the most unaffordable in the history of US. The more sought-after crypto, Bitcoin, has plummeted from $69,000 to $21,000 in a span of just 8 months. That's more than 60% of wealth erosion, and no surprise if it goes further down in the coming weeks. So, in my opinion, all these facts are indicating towards a further asset crash. Let's talk about recession now. There is a lot of hype that the worst is yet to come, and this would be the worst recession ever. But first, what is a recession? A recession is a temporary decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. As per a World Bank data, US GDP growth rate is at a negative 3.4%, the lowest since 1960s. Savings have declined to a record minimum since the 2008 crash. Unemployment rate is currently at 3.6%, the first in the last 30 years. COVID-19 and inflation has already taken a toll on industrial production. Considering all these factors, a recession can be expected. In fact, we have already entered that phase. Now, in the starting of the video, I had mentioned about the benefit. Yes, even in these tough times, one can earn profits from the stock market. So how is that possible? A very simple concept. One makes profit when they buy at a low rate and sell at a higher rate. But in falling markets, we do this in a different order. Sell first and buy later. This is known as shorting. Here, one sells the stock or index at the higher price and buy when the prices fall. This can be done through the stock exchange itself. Just like normal trading, if one is interested, they can buy put options, which will do the same work. However, this is not an investment advice. Please contact your financial advisor for details. That's all for today, folks. Don't forget to like and share the video and post your thoughts or questions in the comments. Hit the subscribe button as I'm coming out with a new video real soon. Logging off.